Like and subscribe. The $1 Investor. I know lately the videos have seemed like they're coming from the Chicken Little Book of Chaos, but I do this so you understand and you know what's happening in our economy. A lot of people in our country are walking around like nothing will affect them. They're walking around with no care in the world, without no understanding of life going on around them. I don't understand how some people can live like that. This will affect all of us. You may not have any money invested. You may not have enough money to save. But if things continue the way they're going, you may not even have a job. This is not meant to scare you. This is not meant to put fear in your heart. This is meant to educate you. It's meant to prepare you. It's meant to show you how these politicians are ruining our country one stupid move at a time. These people have been kicking the can down the road for far too long. Eventually, the piper will need his payment. I'll leave the link of the video I watched on the description part of our video. I broke it down as good as I can. I watched it a few times so I can understand exactly what this man is talking about. This is my opinion. These are my thoughts. I tried to make it as easy as possible so you can understand. I'm not a financial advisor or your financial advisor. I'm just a regular dude on YouTube who drives a bus for a living who is no longer being bamboozled by a system that's rigged against him. Now let's get into the video. Like and subscribe. The $1 Investor. 1. Central claim: a looming $929 billion banking crash. The video's core thesis is that the U.S. banking system is facing a $929 billion maturity wall, a large tranche of debt and loans coming due that banks and borrowers may struggle to refinance or repay. This buildup represents an imminent systemic risk that markets and policymakers are largely neglecting. Maturity wall explained. A maturity wall describes a group of loans, bonds, or financial obligations that all come due within a relatively short time frame. If borrowers, including banks, cannot refinance that debt at sustainable rates, defaults can rise sharply. This $929 billion figure likely comes from financial industry data showing a large volume of bank-held debt obligations, loans, or securities maturing within the next 12 to 24 months, and concerns that higher interest rates, tighter credit conditions, and weaker demand for debt refinancing could trigger defaults or liquidity shortfalls. 2. Why this matters: systemic banking vulnerabilities. The video is placing this maturity wall in a broader context of structural weakness in the U.S. banking system, several of which are documented by financial analysts and reporting. A. Interest rate risk and unrealized losses. U.S. banks hold huge volumes of long-duration securities, treasury and mortgage-backed bonds. When interest rates rise, the market value of those securities falls. Banks often hold them to maturity, not marking losses immediately, but if they must sell assets for liquidity, losses can crystallize. Unrealized losses have been reported in the hundreds of billions at U.S. banks, reflecting this risk. If banks face large funding needs, this could translate into solvency pressures, especially for smaller and regional banks. B. Regional bank fragility and historical precedents. The 2023 banking turbulence, like the collapse of Silicon Valley Bank, illustrated how shifts in rates and depositor confidence can rapidly destabilize institutions with concentrated exposures or poor risk management. That episode highlighted systemic fragilities that could re-emerge under stress. The video likely references this to suggest that if conditions deteriorate, for example, a credit crunch, recession, or refinancing shock, it could be worse than isolated failures, affecting large swaths of the banking system. C. Concentrated debt and credit conditions. Beyond banks' own balance sheets, corporations and households are facing maturing debt obligations in a high-rate environment. Many commercial loans and leveraged loans taken out during a period of lower rates must now be refinanced at much higher cost, creating a potential domino effect from defaults to financial institution losses. Analysts have warned about waves of corporate refinancing needs and commercial real estate stress, which align with the idea of a maturity wall. 3. Mechanisms for a crash. Financial commentary about these risks generally highlights mechanisms that could trigger a crash. A. Liquidity stress/bank runs. If depositors lose confidence, as in past banking crises, they can withdraw funds quickly. Banks might be forced to sell assets at losses to cover these withdrawals, potentially pushing otherwise solvent banks toward insolvency. B. Credit market freeze. As refinancing becomes harder, companies that depended on rolling over debt may default. This increases losses for banks and investors, potentially propagating stress. C. Contagion effect. Losses at one institution can reduce confidence in others, causing credit spreads to widen, capital to flee smaller banks, and tightening lending standards. A feedback loop capable of tipping sectors into recession. 4. Policy and regulatory context. The video likely frames the risk partly as a policy failure, monetary policy tightening, raising interest rates to combat inflation, exposes long-duration debt holders to losses that former easy money regimes hid. When rates peaked, many institutions and corporations borrowed under conditions that assumed low costs of capital, now reversed. Regulators have tools, for example, FDIC backstops, lender of last resort facilities, but the video suggests these may be insufficient or poorly communicated, leading to a lack of market preparedness. 5. Why the video says it's not being talked about. The narrative framing, "No one is talking about this," reflects a common theme in financial warnings. Mainstream media and official reports focus on headline indicators, inflation, job growth, stock indices, rather than debt maturity clocks, liquidity mismatches, or credit market stress metrics. Public discourse often lags real-time risk accumulation because complex financial engineering and debt maturities are less visible than price indices or unemployment rates. 6. Critically assessing the argument. When interpreting videos with dramatic titles, it's important to separate signal from noise. A. Not all debt maturing means default. Having a maturity wall does not necessarily cause a crash. Companies and banks typically plan for refinancing venues, provided credit markets are functioning and interest rate expectations don't spike further. B. Stress tests and regulatory buffers. Post-2008 regulatory reforms require banks to hold capital buffers, liquidity coverage ratios, and stress capital buffers to withstand shocks. Though critics argue the requirements may be insufficient in some segments, whether true systemic collapse is likely depends on the assumptions and severity of shocks. C. Macro conditions evolve. Central banks monitor credit conditions and can adjust monetary policy, provide liquidity facilities, and work with regulators to prevent cascading defaults. Summary: key takeaways. 1. $929 billion. Maturity wall. A large volume of bank and corporate debt is set to mature in the coming quarters. If refinancing conditions tighten, defaults could rise and stress financial institutions. 2. Banking sector vulnerabilities. Unrealized losses from long-term securities and regional bank fragilities, including from past crises, pose risks if liquidity events occur. 3. Credit market dynamics. High interest rates and tightened credit conditions make refinancing expensive, increasing the risk of corporate defaults and credit contraction. 4. Contagion and confidence effects. Loss of depositor or investor confidence can propagate stress across institutions, magnifying initial shocks. 5. Regulatory and policy environment. Monetary tightening, regulatory buffers, and central bank responses shape risk outcomes, but are part of a complex trade-off between inflation control and financial stability. Like and subscribe. The $1 Investor.